There is a pattern that has repeated across every major financial bubble in modern history. It does not matter whether the bubble is in tulip bulbs, railroad stocks, dot-com companies, or mortgage-backed securities. The sequence is always the same. And Michael Burry, one of the most precise contrarian analysts of the last 3 decades, has spent years documenting exactly how this pattern works, why it repeats, and why the people living inside it almost never recognize it until it is too late. What makes Burry's analysis of bubble dynamics different from most is not just the conclusion, it is the methodology. Burry does not rely on expert consensus or Wall Street forecasts. He reads the primary documents. He studies the filings. He models the exits. And what he has found, again and again, is that the anatomy of a bubble is not a mystery. It is a sequence. It has identifiable stages. It follows a logic that, once understood, becomes unmistakable. The challenge is not intellectual. The challenge is psychological. Because recognizing the pattern while you are inside, it requires accepting something that the majority of participants will refuse to accept until the collapse is already underway. This is what Burry calls the bubble pattern that repeats. And if his analysis is correct, understanding it may be one of the most valuable things any investor can do right now. To understand why Burry's framework deserves serious attention, it helps to understand who Michael Burry is and why his contrarian instincts have proven so consistently accurate. Michael Burry did not begin his career as a financial analyst. He trained as a medical doctor, specializing in neurology. During his residency, often working 36-hour shifts, Burry built a following through a financial blog where he documented his investment research in extraordinary detail. His approach was unusual. He did not rely on analyst reports or television commentary. He read actual corporate filings. He modeled actual cash flows. He arrived at conclusions that were often diametrically opposed to what the market was pricing. In 2005, Burry began reading mortgage prospectuses, not summaries, not analyst notes, the actual prospectuses. Thousands of pages of documents that governed how mortgage-backed securities worked. What Burry found inside those documents convinced him that the entire American mortgage market was built on a structural fragility that would eventually collapse catastrophically. He was told he was wrong. His investors demanded their money back. His own analysts questioned his conviction. In 2008, Burry was proven right, with a return of 489% for his investors, while the broader market lost more than a third of its value. Since then, Burry has warned about index fund concentration, passive investing liquidity risk, inflation driven by excess monetary supply, and the accumulation of sovereign debt at unsustainable levels. His method is always the same. He finds what the majority is ignoring. He reads what the majority will not read, and he asks the question the majority refuses to ask. What happens when this system breaks? Burry's analysis of bubbles begins with a critical observation. Every bubble in history has followed the same 6-stage sequence. The names change, the assets change, the justifications change, but the underlying mechanics do not. Understanding these stages is the foundation of Burry's contrarian framework. Stage 1 is the displacement. This is the event or condition that creates the initial opportunity. It may be a new technology, a change in monetary policy, a regulatory shift, or the opening of a new market. The displacement is real. The opportunity it creates is genuine. This is critical. Burry has noted that bubbles do not begin with fraud or delusion. They begin with something that is legitimately valuable. The dot-com era began with the genuine arrival of the internet. The 2008 crisis began with the genuine democratization of home ownership. The displacement creates a rational basis for initial optimism. This is why the earliest participants in every bubble are not fools. They are often the most perceptive observers of their era. The problem begins later, when the rational kernel is used to justify increasingly irrational extrapolations. Stage 2 is the boom. As early investors in the displaced sector begin generating returns, more capital flows in. Prices rise, media coverage increases, success stories proliferate. The narrative builds around the displacement, turning a genuine opportunity into a cultural phenomenon. Burry has pointed out that during the boom stage, the critics are consistently dismissed. The returns are real. The enthusiasm is understandable, and the weight of evidence at this point appears to support the bullish position. The critics who warn about overvaluation are labeled as having missed the opportunity. Their caution is reframed as ignorance. The social penalty for skepticism rises with the price of the asset. Stage 3 is overtrading. This is where Burry's analysis becomes particularly important. As the boom accelerates, credit expands to finance participation. Leverage enters the system. The price of entry rises beyond what fundamentals support, but this is rationalized by the narrative. New participants who understand the original displacement less and less continue to bid prices higher because prices have been going higher. Burry has described this stage as the moment when a market transitions from investing to speculation without the participants noticing the shift. The vocabulary changes. Terms like price-to-earnings ratios disappear. New metrics emerge to justify prices that traditional analysis cannot support. In the dot-com era, it was page views and eyeballs. In the housing crisis, it was ever-rising property values. In each case, the new metric served a single purpose: to explain why traditional valuation methods no longer applied. Stage 4 is euphoria. This is the most dangerous stage. Burry has consistently emphasized that euphoria is the phase most resistant to rational argument. Every concern raised has a counter-argument. Every historical parallel is dismissed as irrelevant. The phrase "this time is different" enters common usage. Burry notes that this phrase, specifically this phrase, appears in virtually every documented bubble in financial history. It appeared in the railroad speculation of the 1880s. It appeared in the stock market boom of the 1920s. It appeared in the technology bubble of the late 1990s. It appeared in the housing market of the mid-2000s. And it is appearing again today, attached to new arguments about why the structural conditions that previously ended expansions no longer apply. Burry's response to this argument is consistent. The pattern has never cared about the specific arguments used to justify it. The pattern has only cared about the underlying conditions, and the underlying conditions repeat. Stage 5 is the crisis. The trigger for the crisis is often minor. A single failed auction, a small fund announcing losses, a regulatory disclosure that contradicts the narrative. But the trigger is not the cause. The trigger merely reveals a structure that could not sustain itself. Burry has observed that the transition from euphoria to crisis is almost always faster than anyone predicted. The system does not slowly deflate, it breaks. Because the leverage built up during the boom and euphoria phases means that when selling begins, selling accelerates. Positions that were financed with debt must be liquidated. Prices fall faster than buyers can absorb. What looked like a liquid market reveals itself to be, in Burry's analysis, a theater where everyone thought they could reach the exit simultaneously. The door does not get larger because the crowd does. Stage 6 is revulsion. This is the aftermath. The narrative collapses. The assets that were priced at euphoric levels are re-evaluated, often falling far below their intrinsic value as the pendulum overcorrects. Investors who participated and lost money swear they will never participate in this type of asset again. This revulsion phase, Burry has noted, is often when the most significant long-term value opportunities emerge. The best assets are priced at their worst because the entire sector is condemned without distinction. It is in the revulsion phase that Burry's deep value orientation finds the most fertile ground, identifying companies whose genuine worth has been buried under the wreckage of collective panic. Burry's core argument is not simply that bubbles are bad. His thesis is more precise and more disturbing. Burry argues that the conditions that produce bubbles are not corrected between cycles. They are amplified. Each successive bubble has been larger than the one before it, because the monetary and policy response to each previous crash has been to inject more liquidity, lower interest rates further, and expand credit more aggressively. The cure for the last bubble becomes the seed of the next one. Burry has pointed to a specific mechanism to explain this amplification. When central banks respond to a financial crisis by cutting interest rates and expanding the money supply, they create what he describes as a forced migration of capital. Investors who might otherwise have held cash or bonds are pushed into riskier assets to achieve any return at all. This forced migration inflates asset prices beyond what fundamentals support. When the inflation reaches a critical point and the cycle reverses, the response is again to cut rates and expand money supply, pushing capital into even riskier assets than before. According to Burry's analysis, this is not a theoretical risk for some hypothetical future. This is the documented pattern of every major economic cycle since at least the 1980s. The savings and loan crisis of the late 80s. The long-term capital management collapse of '98. The dot-com bust of 2002. The housing collapse of 2008. Each crisis was followed by a larger monetary response. Each monetary response seeded the next, larger bubble. Burry's question, the one he returns to repeatedly in his public statements and documented research, is whether this sequence has an endpoint, and if so, what that endpoint looks like. To apply Burry's bubble pattern framework to current markets, it is necessary to look at where each stage of the sequence currently appears. The displacement of the current cycle, in Burry's view, began with the extraordinary monetary response to the 2008 financial crisis. The Federal Reserve dropped interest rates to near zero and maintained them there for years. This was the displacement. Not the arrival of a new technology or market, but the enforced removal of any return from traditionally safe assets. Capital had nowhere to go but into risk. The boom phase that followed was one of the longest in recorded history. From 2009 through 2021, equity markets rose almost continuously. Real estate prices in major markets reached levels that previous generations would have considered incomprehensible. Venture capital poured into private companies at valuations that defied traditional analysis. The boom was real. The returns were real. And the narrative that supported the boom was compelling. Central banks had learned from 2008. They would not allow another crisis of that magnitude. Burry has documented the overtrading phase with specific data points. By 2021, the retail trading volume in the American market had reached levels that dwarfed any previous cycle. Margin debt, the amount borrowed by individual investors to buy stocks, reached all-time highs. Speculative instruments like zero-day options, which did not exist in previous bubble cycles, had become mass-market products. Assets with no earnings, no revenue, and in some cases, no clear business model were trading at market capitalizations that exceeded decades-old profitable companies. Burry publicly noted several of these anomalies, expressing concern that the speculative dynamics had reached a level of abstraction that previous cycles had never achieved. The element of the current cycle that Burry has identified as uniquely dangerous is the role of passive investing in the overtrading phase. Unlike previous bubbles, where speculation was concentrated in a specific sector, the passive investing mechanism ensures that speculative capital flows into every major component of the index simultaneously. When investors pour money into an index fund, that money flows into every company proportionally, regardless of their individual valuation or business performance. As Burry has argued, this creates concentration at scale. The 10 largest companies in the index can account for a disproportionate share of the total value, and they grow larger with every additional dollar invested passively, regardless of whether those companies deserve more capital based on their fundamentals. Burry's specific concern is the liquidity asymmetry embedded in this mechanism. The funds are large. The daily trading volume of the underlying stocks, particularly the smaller components, is not always proportional to the fund size. As Burry explained publicly, the theater is full, but the exit is a door. Under normal conditions, this does not matter. But when the cycle reverses and investors seek to exit simultaneously, the mismatch between fund size and underlying liquidity can produce price dislocations of extraordinary speed and magnitude. Beyond passive investing, Burry has directed sustained attention to the debt dynamics of the current cycle. The United States federal debt has expanded dramatically over the course of the last several cycles. The interest payments on that debt, as interest rates have risen from their post-2008 lows, now represent a significant and growing portion of federal expenditure. Burry has noted that this dynamic creates a structural constraint on policy. The very tool that has been used to manage previous crises, cutting interest rates to stimulate growth, becomes less effective when the existing debt load means that higher rates are creating fiscal pressure on governments simultaneously. This interaction between debt dynamics and monetary policy is, in Burry's framework, where the current cycle diverges most sharply from previous ones. The levers, while still present, are now significantly more constrained than at any previous point in modern economic history. Burry himself rarely provides direct investment advice to the general public. His fund manages capital for sophisticated investors under specific regulatory frameworks. But the methodology Burry applies offers a framework that any investor can use to evaluate their own situation. The first principle is to identify which stage of the bubble pattern the assets you hold are currently in. This requires honest self-assessment rather than narrative acceptance. The question to ask, following Burry's approach, is not whether the investment has been going up. The question is whether the investment is priced based on its actual fundamental value or based on the flow of capital that has been pushed into it by monetary conditions. If the honest answer is the latter, Burry's framework suggests that the valuation is contingent on conditions that may not persist. The second principle is to model the exit honestly. Burry has described this as the most important discipline in risk management. Before entering any position, he models not the best-case exit, but the worst-case exit. What happens to the price of this asset when the majority of holders decide to sell at the same time? Is there sufficient liquidity to absorb that selling without catastrophic price decline? For assets held inside index funds, this question has a specific form. What is the daily trading volume of the underlying securities relative to the total capital held in passive vehicles that own them? The answer to that question, Burry argues, is the actual liquidity available, not the liquidity implied by the fund's own trading volume. The third principle, which Burry embodies most distinctly, is to act on primary research rather than consensus narrative. Burry has made it clear that the consensus narrative is already priced into markets. The consensus cannot produce above-average returns because the consensus is the average. The only way to achieve returns that differ from the average is to identify something that the consensus has not yet incorporated. That means going to the primary sources, the actual filings, the actual prospectuses, the actual data, not the analyst summaries, not the media interpretation, the source document itself. Applying Burry's bubble pattern framework to portfolio construction means being genuinely willing to hold views that diverge from the consensus during the period when the consensus appears to be correct. Burry held his short position on mortgage securities for nearly 3 years while the market continued to rise and his own investors demanded that he close the position. The intellectual and emotional demand of maintaining a contrarian position in the face of sustained adverse price movement is, Burry has suggested, the primary reason that most investors cannot replicate his approach even when they understand it intellectually. The bubble pattern that Michael Burry has documented across decades of market history is not a prediction about a specific date or a specific trigger. It is a diagnosis of a recurring structural dynamic that emerges whenever the conditions for speculation exceed the foundations of genuine value creation. What Burry's framework makes clear is that the pattern repeats not because investors are uniquely foolish in any given era, but because the incentive structures, the monetary dynamics, and the human psychology that produce bubbles are stable features of financial markets. They do not disappear between cycles. They evolve. They take new forms. They adopt new language. But the underlying sequence, displacement, boom, overtrading, euphoria, crisis, and revulsion, remains. Burry's contribution is not to have discovered this sequence. Several economists before him identified similar dynamics. His contribution is the precision of his application and the documented record of his willingness to act on his analysis when the cost of doing so was extremely high. Most investors who understood that the mortgage market was fragile in 2006 did not build the short position that Burry built. They understood the analysis, but could not sustain the position. Burry could. The question that Burry's life's work ultimately poses to every investor is the same question it posed to his investors in 2006. Do you actually believe your analysis? And if you believe it, are you acting on it? Or are you, like the majority, waiting for the consensus to confirm what the data already shows? History, as Burry has repeatedly noted, suggests that by the time the consensus confirms it, the opportunity has already passed. Thank you for watching.